not. But let's get our first guest on board. Matt Orton, who's the Chief Market Strategist at Raymond James Investment, is joining in now to give us his view on the market. Matt, good morning. As always, thanks for being with us on the channel. There's lots to watch out for this week, as we were mentioning. There's Jerome Powell's comments, there's the jobs data as well. But do you think this higher for longer interest rate scenario is something that could continue to have a long-drawn impact on the economy and on stocks? Or do you think the worst is over, at least for equity markets?
Hey, good morning, Sonia. Great to see you. And I think this higher for longer environment still needs to work its way through the market. So we've seen areas like information technology, higher duration parts of the market outperform, even though we have seen rates move higher. And that disconnect is what needs to be resolved before the market can really start to sustainably move higher. It's incredibly encouraging that we've had very, very strong economic data continue to come out of the US. We've seen really good data coming out of Europe. We've seen stronger global data. The Chinese reopening continues to improve and go as planned. So there's a lot of support from a global economic front. But until markets fully impound what higher for longer actually means, and we are not there yet, the market continues to fight, equities in particular, what the Fed has been saying and the moves that we've had in rates. Until that normalization happens, I continue to tell our clients it makes sense to remain defensive. Lean into higher quality companies, companies that have higher free cash flow, earnings growth stability, where we've seen improvements in terms of EPS expansion going forward, and that applies globally. That area has held up well in both downturns. It's outperformed on the upside, and those are the types of companies I want to be leaning into until this normalization really fully plays out.
Hi, Matt. Good morning. So leading into defensive quality names, you've said that in the past as well. Over the weekend, though, we had China's growth projections for this year around 5% odd, maybe a little lower than some expectations, but better than what they did last year. What's your approach to the Chinese market? And do you think you prefer them over the Indian markets? Or post the recent underperformance, India comes back into the reckoning?
Hey, Nigel, good to see you. So China is an area where I liked it after the kind of the bottoming in October heading to the end of the year, but I think there are better ways to play the Chinese reopening. And we've talked about this in the past, and it's really Asia ex-China, so Asia Pacific, so call it the Philippines, Indonesia, Thailand, South Korea, Taiwan. Those are countries that have exposure to financials, to semiconductors, to industrials, areas and trade that will benefit with the Chinese reopening, but it's broader than that. They have exposure to the US and to Europe as well. And so I really like to play, I'll call it Asia Pacific ex-China. It is the way within emerging markets to get exposure to the Chinese reopening without taking on some of the risks that you have in China. And a lot of the growth we've seen in China has been concentrated in just a handful of names. It's been information technology, it's been communication services companies, and we've seen the flip side of that over the past few weeks as well. India is an area that's interesting. You know, we talked about this in the past too, where I was a little bit less, I'll say, enthusiastic relative to Asia Pacific, just because of the issues with the Adani Group. But I think we've seen Indian equities hold up well. And in particular, I really like the Indian banking sector. I think Indian banks have posted good earnings. We've seen my thesis of net interest margin continue to play out through earnings season. Credit loan books continue to expand. So I think the relative strength of the Indian economy helps the banking sector. And some of the weakness we've seen in Indian IT services, I think, also is an opportunity going forward. So I also prefer India over China as an investment within emerging markets.
Matt, that sounds good to us, music to our ears. But you mentioned Adani in passing. I don't know if you were following events that played out over Thursday and Friday. I wonder if you're convinced that the worst of this entire story is behind us, because now there is a fund that's come in and it's put some money up on the table. So do you think we're past the hump on Adani and the market can continue to now move on fundamentals, technicals, usual parameters?
Right. It's really hard to say because the news flow has slowed, the negative news flow has slowed, and that is encouraging. And I think we've seen some relative strength. We've seen a bounce back in some of the Adani Group companies. That, I think, is helpful. We haven't seen as much credit stress. You've seen the Adani Group come out, as long with some of its creditors, generally support the company. But it's really hard to say what fast money can do. And so if I were looking at India, that's why I want to be selective with the sectors in India industries where I would put money to work right now. And so I think that's why you would want to lean into banks, into information technology services companies, where I think valuations are still fair and you're relatively insulated from some of that potential negative news flow.
Well, it's always great speaking with you, Matt. Have a great week, and thanks for joining us on CNBC TV18. That's a global strategist saying that he prefers India over China, but there's still, it's time to still be a bit defensive in the market, and there's still a bit of caution. Let's slip into a quick break. On the other side of the break, we'll get our entire research team to tell you about the top 10 stocks that you need to watch out for as we begin a brand new week of trade. Stay tuned.